Hi, I'm Lee Stone, and this is your Week in Forex from UFXBank. Today, we will review last week's market highlights with financial analyst Martin Smith. Most of the week's financial news surrounded the G20 summit, where concerns about the global economic recovery pointed to signs of a possible slowing down period. The debt crisis in Europe again made headlines as Moody's Investment Services downgraded Spain's AAA rating. But the biggest news of the week came on Friday, when the U.S. jobs report was released. This will present a huge impact on the dollar in the coming weeks. To better understand these events, I'd like to welcome analyst Martin Smith. Thank you for coming.
Thank you, Lee.
Can you explain a little to us about the data out of the United States?
Sure. The jobs report you mentioned indicated that U.S. unemployment fell by 125,000 workers. Now, this is the first drop this year. Of course, the fear is that the recovery has slowed down. Now, earlier in the week, there was also data regarding housing, manufacturing, and consumer confidence, and all showing less than positive signs for the U.S. recovery. Now, we could see that they had their own impact on the dollar's value before this news, but now with the jobs report, a little better than what some analysts feared, the dollar will likely take a hit in the coming weeks. So all of these reports now indicate that the interest rate in the US will remain near 0%, and of course this greatly reduces demand for the greenback.
Well, now after the report was released on Friday, the euro increased 1.5% against the dollar. And some analysts are expecting this to continue in the near term. But what about the debt crisis and the news out of Spain?
Well, Moody's downgrading was not necessarily unexpected. However, it still shows uncertainty in the European banking community. And let's not forget, there was also positive news earlier in the same day. The European Central Bank indicated they would be lending banks less money than expected. Now, many are viewing this as an easing in funding pressures among financial institutions, another indication of growing confidence in the recovery. Now, comparing this with the news out of America, investors are likely to push their money towards the euro, at least for the near term.
Asian stocks declined this week amid news from China. Could you discuss this a little?
Sure. Goldman Sachs lowered its Chinese economic growth forecast, and that led to a slide in commodity prices. And oil, in fact, fell below $73 a barrel after this news was released.
Now, why were commodities so heavily affected?
Well, essentially, the manufacturing index in China has been decreasing since earlier in the year, reducing the amount of commodities being purchased. Now, the lower rate of production means less demand for oil and other commodities used in production. The decrease was not so significant, but since China is such a large consumer of resources, any fluctuation in their manufacturing index will have a huge impact on the price of commodities.
Now I'd like to move on to a featured segment we will be doing every week during our weekly review. Ask the Broker. This is where you, the viewer, can submit your questions regarding Forex trade or different behaviors or trends you would like to understand in the Forex market. Each week, we will pick one question to have our expert analyst answer during our weekly broadcast. Remember though, our videos are produced at the beginning of the business week, so some inquiries may not be relevant on the day of production. Today's question comes to us from Stockholm, Sweden. Johan Didrikson writes, "What can you tell me about the link between commodities and currencies? For example, what is the relation between gold and the US dollar?"
Well, there's a lot to be said about the connection between commodities and currencies and how they relate to each other on the global exchange. It would take quite some time to go over every commodity. But if I can focus on gold, then maybe I can explain a bit. Now, gold and other commodities are resources. They have a practical use, and therefore they will always have value based on that resource's demand. Now, in times of economic uncertainty, commodities like gold become an economic security and a safe haven against inflation. Now, since gold is priced in dollars, when the value of the dollar increases against other major currencies, the demand for gold decreases, and therefore the price drops. Now, at the same time, if there's a significant demand for gold, the price could just as well increase. If anything, the price of gold is based mostly on speculation. Now, there are many factors that influence the price of gold: inflation, interest rates, anything that can affect the level of demand. All of these have a significant influence on the price of gold. The surge in gold prices over the last 2 years occurred mostly because of the crisis. Banks and governments needed a safe way to keep their money, and so they turned to gold. The demand for gold drove its price up. Now, if India, for example, announced tomorrow that they were going to back their currency with gold, it would dramatically increase demand and therefore price. But if interest rates suddenly rose, the demand for gold would decrease, and so on.
Thank you, Martin. That's all the time we have. Be sure to visit us at UFXBank.com for simple, safe, and secure trading. Also, you can follow us on Twitter and Facebook to submit your own questions to our weekly broadcasts. Please email your questions to Martin Smith at askthebroker@UFXBank.com. I'm Lee Stone, and this was your UFX Bank Week in Review.